Well, good morning, everyone, and welcome to Aviva. For those of you that were in the room for the Friends Life presentation this morning, I hope you enjoyed it as much as I did. I must confess it was an interesting experience sitting on the other side at a results presentation. You know, I was going through my mind at the time, I was imagining all those difficult and obscure questions I could think of, but congratulations, Malcolm and Andy and Tim and the team. Using my vernacular, very satisfactory results. Now, when I arrived at Aviva a couple of years ago, it was clear that there were a number of issues to address. And I've always been very consistent that there is much to do. There still is. But taking a step back, I think you would agree today that today's results show tangible progress and leads us nicely into the Friends deal from here on. So let's look at the numbers. The numbers are, to, I guess, coin a phrase, entirely adequate, with all the key metrics moving in the right direction. Cash, which of course is our most important metric, that's up 11% to £1.4 billion. But probably more importantly, our holding company excess cash flow, or as my friend Tom here calls it, our after cash, that's up 65% to £692 million. That's very satisfactory progress towards our £0.8 billion target. Operating profit for the group, that's up 6% to £2.2 billion. And that's despite there's headwinds in foreign currency and lower interest rates and lower annuities. But there's some headwinds and tailwinds there that we'll take you through later. And our operating EPS is, of course, up more than that because of the restructuring done with the business, in particular with the minority interests. And so EPS is up 10% to 47 pence. In 2014, we continued our drive for efficiency throughout the business. And we've been on this journey for a while, and we're going to be on it for a lot longer as well. Now, total expenses are down 7% in the year to £2.8 billion, and that shows a cost reduction of £571 million on the 2011 baseline of expenses. That was, of course, as you know, against our £400 million target. Our value of new business, which we look at as our growth metric in life insurance, that increased 15% in constant currency to just over £1 billion. That's actually the first time we've ever surpassed the £1 billion mark in our history. In general insurance, our combined operating ratio has improved to 95.7%. And this has seen our underwriting result. Now, the underlying underwriting result, is the true measure of growth in general insurance, and that has grown 54%. Our balance sheet has also improved. IFRS book value per share is up 26% to 340 pence, and MCV book value is 14% higher at 527 pence per share. Now, I recognise that this result on book value could be characterised as, surprisingly desirable. But I don't want us to all get carried away just yet. Some of this move was from IAS 19 in terms of the pension accounting, and Tom will take you through that in some depth later. Debt is also lower. And so our leverage ratios today are now almost within our target, and that's before the impact of the Friends acquisition. Our economic capital surplus is stable, and our liquidity is also within our risk appetite, again, before the Friends transaction. Now, the natural consequence, I guess, of an improved financial position and performance is an increase in dividend. And our 2014 dividend, as you know, is 30% higher, taking the total 2014 dividend to 18.1 pence for an overall full-year increase of 21%. Now, hopefully by now you've become accustomed to my style. We've had quite a few meetings like this. I like to focus on our problems more than I do our successes, and that's certainly the way we run our group. Now, one of the benefits of coming to Aviva is that there's been no shortage of problems to address. And as I outlined in July to you in the analyst days, I outlined a summary of the key issues as I saw them. Now these, I'll call them historical issues, because obviously some of these have been addressed a little bit quicker than we had anticipated, but these historical issues fit into two buckets: cash flow on one hand and growth on the other, which, as you know, encapsulates our investment thesis. Now, you've seen these issues before on the slide. So first, let's look at the cash flow issues as we see them. On efficiency, as you remember, we set out a target in July of achieving an expense ratio of below 50% by the end of 2016. In 2014, the expense ratio has reduced to 51.5%, so we are on track, but frankly, you know as well as I do, more can be done. Secondly, our excess cash flow has long been inadequate at the group centre. And I think we're probably unique in insurance companies the way we define excess cash flow, that really it's after. And our excess cash flow historically had been inadequate even to cover the dividend at the group centre. Our 2014 excess holding cash flow is 65% higher, and for the first time the surplus more than covers the cost of the full-year dividend. Now, while our standalone target of £0.8 billion of holding company excess cash flow, we've announced that our Friends Life deal is expected to add a further £0.6 billion to this. And the question, of course, is how quickly can we achieve it? The third issue I mentioned was that our life back books are inefficient and capital intensive. And today we announced just under £300 million of profit from net, that's pluses and minuses, from our back book initiatives. Now, I've also articulated that there are many more hundreds of millions of operating profit to come from our back book projects around the group, and this will happen over a number of years. And finally, on this slide of the issues, our leverage has been an issue that has hampered our flexibility for a long time. Now, you've seen the results today. This is clearly much less of an issue now than it was even a year ago. And our 2014 leverage ratios are 41% of tangible capital and 28% on my preferred S&P basis, which is also within our target range. And the combination with Friends takes the issue of our external leverage off the table for the first time in a long time. Now, I think that position itself would have seemed unrealistic, totally unrealistic to many just 2 years ago. Now, growth is a second part of our investment thesis. And it's clear that as our cash improves and as our dividend payout ratio normalises to the 2 times, we need to deliver on growth. And over the next few years, you will see us much more actively reallocate resources. That's both capital and people to the growth businesses and the growth cells around the group. So the question, of course, is where will we allocate this capital? Now, you know that I think it is total nonsense to look at insurance by region, as each market has its own regulation and characteristics. There is little in the way of economies of scale regionally in insurance in Asia or Europe or anywhere else for that matter. That's why we look at insurance market by market, and even within that, frankly, cell by cell. So you will see us seek out growth from businesses and cells in both mature and developing markets alike. You look at Asia and some markets like India, like Indonesia, like China, like Singapore, and in Europe and places like Poland and Turkey, where we have some leading positions in some of these exciting insurance markets. But the point is also that the UK has very attractive prospects for growth in certain segments. For example, the UK corporate pensions, we expect to capitalise on our clear scale and cost advantage, and we do have a cost advantage now in a market that should triple within 10 years. In addition, our brand and composite position gives us a systemic competitive advantage in general insurance if we can make use of it. Now, we've also made it clear that we need to grow contribution from profits from our asset management business. I'd like that to be a much bigger part of our profit contribution. And the best way to do this is by growing scale and by growing our third-party fund flows. Now, the Friends transaction takes care of the scale point. That's the first part. And for our external fund flows, we are focusing on our AIMS range of products. And the AIMS fund currently, this is 8 months after launch, currently has just over £1 billion of funds under management. And we would, especially with our recent distribution agreement with Virtus, we would expect that momentum to continue. So there's a bit of expectation on you, Ewan, for AIMS, just as an aside. Now, the net fund flows across the group are also important. And in 2014, we had £2.7 billion of positive life flows. That's obviously excluding with profits. And our UK fund platform now has over £5 billion in it. That's double what it was last year. And what about cross-sell? We've spoken about that before as well. Now, I know I'm not going to convince many of you in this room that this is going to make a meaningful difference in the near term. That's okay for now. Indeed, history is littered with failed attempts at financial firms trying to increase cross-sell. But of course, the difference between this current environment and that of the past is that the impact of digital on how we sell to our products and how we engage with our consumers, and the substantially lower number of intermediaries in the market. That's just life in a digital world. And I would note that we do have some pedigree in this business, and last year alone we wrote over £1 billion of digital and direct revenue in 2014. So now to a few remarks on the Friends transaction. I've read a lot of research. In fact, I read all of your research, but I've read a lot of research that's on us that suggests we're going to be distracted by the Friends Life integration. Keep on writing it. Because why I say this, because it helps me manage the change that we need. It adds impetus to more dramatically overhaul the way we do business. You see, the way I look at transformation and turnarounds in a business like Aviva is you need a catalyst. And this is a great catalyst. But I do agree it's not going to be easy. We need to integrate as fast as we can, knowing there will be some pain in 2015 and it will be messy. But let me just remind you about the size of the prize once we execute. The transaction should give us $600 million of incremental cash flow. And I think we've proven when we put numbers out there, we will generally deliver. It will give us $225 million of expense synergies, the ability to move to 2x cover ratio on our dividend. Strategically, it secures our leading position in our home market of the UK. That's good. It brings 5 million customers to Aviva for us to cross-sell our broader range of products into, whether it be GI or the wider range of life products or asset management. It gives us a bigger backbook from which we can extract synergies and greater expertise in this area from the, I think, exceptional job that Friends Life team have done on their heritage books. The deal adds scale to Aviva investors by insourcing up to £70 billion of funds under management, helping it become a bigger contributor to overall profits. And finally, of course, And please don't underestimate this, but finally it gives us high levels of capital and cash, and that allows for opportunities for investment in other growth cells and growth markets where we see high returns and high growth. Now, I have full confidence in Andy, who you've heard speak this morning, and of course Nick Amin, our integration director. I have full confidence that they will extract the synergies we have targeted, and detailed planning on this is, as you would expect, well underway. Now, that we are able to even contemplate such a transaction such as Friends Life, I think shows improvements we've made over the last couple of years, including repairing the balance sheet, reducing costs, and growing the profitable segments of the business. So when you think about it all in that context, and before when I was talking to a number of you, a couple said, are you happy with where Aviva is at? Well, of course not, because I think we've got a long way to go, but I guess I am happy with the progress that we have made. And as the numbers show, we have come a long way in a couple of years. And talking of the numbers, to talk you through these in more detail, I'll hand over to our CFO, Tom Stoddard.
Thanks, Mark. Good morning, everyone. Aviva's transformation is continuing, and I'll take you through more of the details. As our results show, we continue to lay the foundation for the future, making progress on improving our financial performance and increasing our financial flexibility. Full-year results are positive. We've achieved a good bottom line despite unexpected adversity, regulatory change, and competition. As you work your way down the left-hand side of this slide, you can see that the results get better and better. Overall operating profit is up 6% to £2,173 million. After restructuring costs, we're up 21%. And profit after tax is 91% higher at $1.7 billion. Looking at the bottom right, the number I focus on is operating EPS, which is up 10% in a difficult environment. We've had both headwinds and tailwinds this year, so let's look at the upper right of this slide and start by ticking off the headwinds against us. Outside the UK, foreign exchange has been a big drag, with the euro, Canadian dollar, and other currencies depreciating against sterling. This has depressed operating profit by $87 million. Here in the UK, regulatory actions have set us back as well, with our life operating profit from individual annuities down $70 million. And not having Aviva and CXG in Spain, Eurovita in Italy, and our River Road asset management business in the US meant foregoing $42 million of operating profit relative to 2013. Adding that all up comes to about $200 million of negatives against profit to overcome. And I haven't even mentioned the low interest rate environment, some bad weather in Canada, and the recently announced FCA settlement costing us £18 million in other operations. Nevertheless, as you can see from the slide, our focus on efficiency has paid off, enabling us to sustain our overall momentum with expense reductions and backbook impacts, including the tailwind of favorable mortality experience on our approximately $30 billion of annuity reserves, enabling us to achieve operating profit growth. At the same time, we've continued to recruit talent into the organization, with expenditures on digital, customer, and asset management initiatives, reducing current profits but enhancing our prospects for the future. Now, this next slide is a new one to take a closer look at operating EPS and ROE, consistent with my theme of paying attention to the bottom line after. The key thing to take away here is that, in addition to growing operating profit, we've reduced the cost of minority interest through our restructuring efforts in Italy and Spain. This directly benefits shareholders by adding to EPS. Also note that in 2015, the DCI cost will be lower, given that we called the capital instrument in November, having pre-financed it with hybrid debt in July. The other observation to make on this slide is on IFRS return on equity. While we're very focused on improving returns on capital, and we really like the increase shown on this page, up over 200 basis points to 17.4%, you should note that we compute and report ROE based on opening equity, which was a little less than £8 billion for 2014. However, as you'll see on the next slide, our book value has gone up significantly this year to £10 billion, so opening equity for 2015 will be much higher. That will obviously affect the ROE number that we report next year. In any event, we focus primarily on long-term economic returns. So moving on to book value. Growth in net asset value per share, NAV, has exceeded my expectations, increasing 26% to 340p. The contribution from retained earnings is satisfactory, but note that the movement in the pension fund is especially favorable and highly dependent on factors outside of our control, such as interest rates and credit spreads. We do not manage our pension funds on an IFRS basis, so you should expect continued volatility from this line as we reported under IAS 19. We've looked at hedging the accounting impact, but the cost is expensive and probably not in the best interest of shareholders. Instead, we manage our staff pension funds on an economic basis in accordance with actual funding requirements. On that basis, the Aviva staff pension scheme is about fully funded, but not overfunded as the IAS 19 reporting would suggest. So we're effectively overhedged in some respects relative to the IFRS surplus, and in 2014 this meant that widening UK corporate bond spreads and falling interest rates resulted in a £1.3 billion increase in our pension surplus on an IFRS basis. Put simply, the 70 pence increase in NAV is more than what I would ordinarily expect in the year. What I would have expected, ignoring the pension fund, investment variances, and foreign exchange, but deducting dividends and restructuring costs, would be approximately a 30 pence increase from operating activities. In any event, we'll continue to watch NAV closely as growth in book value will be important to sustain future growth in the business. Now, turning now to our individual business units, our largest, UK Life, has had a momentous year, beginning with changes to the annuity market and ending with the proposed combination with Friends Life. In the midst of this, UK Life has delivered a 9% increase in operating profit and a 30% increase in cash remitted to the group center. As you know, we've been managing UK Life to increase cash remittances, and they have, rising from $150 million in 2012 to $300 million last year and $390 million this year. The business has benefited from an active capital management program and de-risking activities. Now, the cost of these de-risking and hedging activities has been a negative to operating profits, but they benefit capital and cash, so I consider them worthwhile. At the same time, our operating profits have been further reduced by lower volumes of individual annuities, which certainly was not desirable. So profitability in UK Life would have been down if we had not also benefited from a 7% reduction in operating expenses, as well as from favorable mortality experience. For 2014, we released $282 million relating to longevity assumptions, versus $66 million in 2013. From the half year, you will also recall that we had released a significant expense reserve, but this has now broadly been offset by a charge we've taken to DAC, primarily related to the DWP pension cap. We did not have a comparable expense reserve release in the second half, but as Mark said, we may in the future, and we continue to take actions affecting our back book. In terms of trading, our results on value of new business recovered nicely in the second half and ended approximately even for the year, with strong results in equity release, bulk purchase annuities, and protection offsetting declines in individual annuities. Net funds flow were a positive $1.5 billion, driven by an 88% increase in managed assets on our UK Life platform. So, despite adversity, this business has delivered in its role of providing increasing cash to the group while also responding to a changing marketplace. We look forward to improving it still further with the addition of Andy Briggs and the combination with Friends. Now, turning to UK GI, our underwriting profit was up 70% to £199 million. The combined operating ratio was the best in 15 years, coming in at 94.8%, reflecting expense efficiencies and relatively favorable reserve development compared with the prior year when we strengthened commercial motor reserves. Net premiums written were down 4%, with most of the decline happening in the first half of the year. The last quarter of the year was basically flat, with an encouraging pipeline going into 2015. Overall, UK GI did well to deliver operating profit growth, up 6% to $455 million, despite earning $70 million less investment income because the internal loan ran at a lower balance on average in 2014. Now, bear in mind that the investment income on the internal loan to UK GI is an expense to the center and is eliminated in consolidated results. GI market remains very competitive, so we're continuing to focus on expense efficiency, underwriting, better investment management, and capital management. Results in Europe have been solid, with operating profit up 9%, value of new business up 27% in constant currency, and cash remittances up 17% to $454 million, despite adverse foreign exchange movements. V&B in Europe has benefited from higher sales and margins of unit-linked products in France, as well as margin improvements in Italy and Spain for management actions to reduce the level of guarantees on with-profits products. In France, our largest business in Europe, operating profit was £452 million, which is about the same size as UK GI. Italy was a star in turning around cash, V&B, and operating profit. Spain returned significant cash and capital. And Poland delivered $192 million of operating profit, VNB growth of 31%, and cash remittances of $106 million. Cash flow and growth. In Turkey, we completed a successful IPO of our life insurance business, Aviva SA, and extended our bancassurance joint venture with Sabancı Holding for another 7 years. We're also pleased to have completed the exit of our GI business in Turkey in December. In Canada, we experienced good growth, with net written premiums up 6% on a local currency basis, but the Canadian dollar was 13% lower against sterling on average during the year. Nevertheless, cash remittances were also up 6% in sterling to £138 million. Large losses, weather, and less favorable reserve development affected core, but management has been disciplined on expenses, so the net result overall is that core in Canada deteriorated 1.5 percentage points to 96.1. In any event, Aviva Canada is one of the core cash generators in the group, with a high return on capital plus opportunities for profitable growth. We will continue to focus on underwriting results here while also advancing our customer and digital agendas. Okay, switching back to the overall perspective. Value of new business for the group was up 15% in constant currency, which shows the benefits of diversity and indicates the potential for growth across Aviva. In the UK, strong margins in equity release and higher volumes of bulk purchase annuities helped keep us even for the year, despite all the changes to the annuity market. Meanwhile, our growth markets of Poland, Turkey, and Asia accounted for 22% of group VNB and have grown collectively 25%. Turkey was down 3% in constant currency, in part driven by local market conditions and in part by the IPO diluting our share of the total. China, meanwhile, doubled its VNB, continuing very strong growth. And at the bottom of the slide, you'll see that our new business margin was up overall, and in fact, it was up in virtually all of our individual markets. And the next slide illustrates components of our GI combined operating ratio for the group. In our disclosures, we've also added a new table showing how this breaks out regionally in the UK and Ireland, Europe, and Canada. Overall, as you can see, in 2014, we had a slightly higher underlying loss ratio, but we benefited from improved expense management and had fewer lines where we needed to strengthen reserves, so our overall net development was more positive. In total, the group core improved to 95.7%. We still believe there's room for improvement in core, but we want to balance this with growth, as the point is to increase underwriting profit year over year. In 2014, Aviva's underwriting profit was up 54% to $321 million. Now, as you know, at Aviva, our business units are all very focused on continuous improvement, and you can see that from the segment expense ratios here. Life operations have led the way with a significant improvement in expense ratio from 33.3% down to 30.1%. GI has made progress, while fund management and our smaller health segment have been about flat. We expect to continue to grow Aviva Investors, which means spending money on people, product development, and distribution in the short term, so it'll be harder to improve the fund management expense ratio until we bring in more assets under management. That's the scale point Mark was making. Overall, the expense ratio is down to 51.5%, which is progress towards our target of getting below 50%. Putting it all together, our business units have performed well, with cash remittances in sterling increasing 11% year over year. This will continue to be an area of focus for us as we look to improve the cash flow efficiency of the group relative to our operating profitability. Moving down the slide, we've also become more efficient at the center, with the net effect being that excess cash flow at the center is up £272 million, a 65% increase, and good progress towards our standalone target of $800 million. This provides good support for the long-term sustainability of growth in our shareholder dividend, which we raised to 18.1 pence for the year. And we still have much more work to do to improve our cash flow on a standalone basis. However, as I've said before, the proposed acquisition of Friends Life is accretive to cash flow coverage and cash flow per share. You can also see that our operating EPS dividend cover ratio has moved from 2.8 to 2.6 times, and we are reiterating our intention to move it to 2 times over the medium term. This is consistent with our investment thesis of cash flow and growth in that order. Turning finally to the balance sheet. We've managed our economic capital surplus throughout the year to stay within our risk appetite while continuing to improve our overall financial flexibility and resiliency to stress. On a like-for-like basis, our economic capital is up slightly, and our cover ratio is exactly the same as last year at 182%. This year is a little different, however, in that we announced our final dividend early in December at the same time as the Friends Life transaction announcement. Our liquidity also remains within our comfort levels at approximately £1 billion. It was more elevated a year ago, including proceeds from the sale of our U.S. operation, which closed in 2013. We've used cash to improve our financial position in 2014, reducing external debt by $305 million, bringing down the internal loan, and investing in subsidiaries such as the internal reinsurance mixer. Through cash and non-cash actions, we've brought down the balance of the internal loan another $1.3 billion to £2.8 billion now. We remain on track to get the balance to the target $2.2 billion level by the end of the year in 2015. As Mark pointed out, our debt leverage has improved to the point where our current priority is to reduce our financing costs and improve the composition of capital. Our leverage stands at 28% on an S&P basis, which we consider a better measure than the TNAV basis, where we've improved to 41%. With the Friends Life acquisition, we see no further requirement to delever. The Friends transaction will make our reporting a bit more complicated during 2015, but once the deal is approved and closed, we will work with the analyst community to help you understand what the combined company should look like. And that concludes my review of our results. 2014 was an exciting year for Aviva, and 2015 is shaping up to be another one to watch. We enter the year with better financials and better prospects, and yet still much more to do, starting with the combination with Friends Life. So before we go to questions, I'll turn it back over to you, Mark.
Thanks, Tom. I'm always interested when my CFO describes it as exciting. I'm not sure whether that's a good descriptor or not. But it has been 2 years, isn't it, since we launched our cash flow plus growth investment thesis. And I hope you'd agree that today's results show some tangible progress in all those key areas. We've identified the major issues to overcome, and we've tackled these. We've launched our strategic anchor. We've launched our value set, and we are seeing the early signs of changing our business model, and these are emerging. But frankly, they need to continue to emerge. We've completed the major acquisition. We have a major acquisition to complete. We haven't completed it yet. We have a major acquisition to complete and to integrate, and with all of that, it's going to be quite a year. But before I open up to Q&A, I just wanted to take a few moments just for a few comments about John McFarlane. So this is indeed his last results presentation as chairman of Aviva. Now, as you all know, John is taking up the role of chairman at Barclays, and I'm sure, John, they will benefit greatly from your experience and your insight and your wisdom. It, of course, was John who kicked off the initial turnaround at Aviva. And indeed, John is the reason that I'm here as well. And personally, John's been a great support for me. He's offered wise counsel and plenty of challenge. And John, I will miss your guidance, but I know you'd agree totally that John and I and the team are delighted that we have the board continuity, and will greatly benefit from the experience of Sir Adrian Montague. Adrian's got outstanding experience, and we know him well, and has been a key part of this journey that we've been on with the board. And also, we, of course, have someone of the pedigree of Sir Malcolm as our new SID. So we, I guess, say goodbye to John. Welcome Adrian as the chairman, and welcome Malcolm and, of course, Andy to the board as well. So, John, best of luck at Barclays. Mm.
I haven't gone yet.
I should point out, John's really going to be judged on an EGM that is on the 26th of March and an AGM shortly to follow it after. So John, don't screw it up. And with that, ladies and gentlemen, let's open up for Q&A. As usual, I have some of my team here, and we can move on. Now, I'm starting with John. As you can't write any notes, I know you're conflicted out from writing notes, so you get the chance for the first question, then we'll move around the room.
Thank you. Sir John Hockey from Morgan Stanley. I've got three questions, please. First, on capital. Just wonder if you could give us an update on how confident you are with the Solvency II approval process, and just practically how it's going to work with Friends. Does that create complications in the transition year? When do you expect to get the full economic capital benefits of the merger?
Okay, a few comments and I'll pass over to Tom on how we're going to do it with Friends. Solvency II, as you know, has come a long way in the last couple of years. I think when I first came here, it was, I will say, unsatisfactory to say the least. I mean, just the form of Solvency II. And each month that's gone past, you've had more certainty and more clarity, and as we've gone through an internal model, where, as we work through that process, about sort of where we thought would be. But I always put a strong caveat on. There's still unknowns. There's still a lot of unknowns we still have to work through. But the process is going in line with where we expected. Tom?
Thanks, John. Obviously, Solvency II has been a big area of focus for us, and with the upcoming transaction, an even bigger area of focus. So as you might imagine, we've spent quite a lot of time with the regulators talking about the implications of that transaction and trying to get comfortable from a Solvency II perspective, and we obviously have. In terms of exactly how we're going to manage the transition, Friends will be on a standard formula basis to start. And again, once we complete the transaction, we'll start the transition to bring them onto our partial internal model.
And I should point out that not all of our countries will be on the internal model. In some of our countries, it just partly time and regulators and focus. Some will be on the standard model to start with in some of the smaller countries. Andrew, you were next.
It's Andrew Green at Autonomous. 3 questions. Firstly, could you used to give us what the value of the buyout basis on the pension fund is? I wonder whether you could supply that. It may be in the documents, I'm not sure. Secondly, you talk quite a lot about hundreds of millions of potential benefits, particularly in the UK life side. Yeah. Can you give us a bit more visibility on this? The one we're particularly focused on is the expense loadings relative to where your expenses currently are. It'd be useful to have some visibility around that. And then thirdly, you're aiming at this 1.4 billion after. Yep. Can you talk a little bit about what, that's free of any encumbrances on it. Why shouldn't one pay the whole of that out?
I'm going to answer the third question first, and then I'll pass over to Tom. When you're in a business and the thesis is cash flow and growth, obviously you need to balance that out. While we're not paying it all out, as we have a 2 times cover, is where we're targeting it. Of course you could, couldn't you? But I'm not going to give any guidance on that today. So the answer to your question is, of course you could. Of course you could, but the only guidance we're going to give on dividends today is that we've got a 2 times earning cover. Okay, so I know that's not particularly helpful for modelling, but of course you could. Do you want to answer?
Sure, I'll give you my perspectives, which I agree with Mark, 100%, but, part of the decision will be where can we invest capital and get good returns. And, if we don't see good returns, we'll look to return that to shareholders. And if we think we can get good returns, we'll continue to invest in the business. In terms of your 3 questions, first on the pension schemes, we're approximately fully funded right now on an economic basis. I don't think we've provided anything around what the cost would be to buy it out, but I can say that right now the way we manage this, we're approximately fully funded. In terms of back book actions and expense policies, we haven't provided any guidance on precisely the amount and timing in terms of predicting when those actions may come through. We will be developing policies in terms of how we report that and in terms of securing expense saves, and so we'll work with the analyst community once we've got the transaction completed and closed to sort of talk about those policies. I think that covers it, Mark.
There's a lot of actions to take in the back book, isn't there? So some of them, for example, as you say, are expense savings, and you know how it works because they're all capitalised and then you release them. But so it's tangible management actions that lead to that stuff. We've got a pretty good idea of what we're planning on the next few years, but we've got to execute, and there's a lot of work to do. And I think the big plus is we've got Andy and his team that, frankly, have more experience on it than we do as well. So there's a long way to go on that. Yeah, Chris.
Hello, Chris Erson from Credit Suisse. Two questions, please. Firstly, so you've progressed pretty solidly on value of new business, but when I look at your undiscounted free surplus, it fell in aggregate over the course of the year. Now, you allude to FX playing a role in that, but I wondered if you could please provide some sort of breakdown between underlying progression in free surplus and the FX component of that change. Secondly, just looking at the sort of half-by-half numbers, there was quite a big improvement in new business strain in the second half of 2014 compared with the previous 3 half years, and that seemed to be driven by the UK, where you had positive strain of 37 million in the second half. Would be interested if you could provide some details on what caused that as well, please.
Sure, I'll take both those. On the undiscounted free surplus, I think if you look at that closely, you'll see that almost all the impact there is in the final bucket, sort of the very long-term cash flows, 20 years and further. And so it's driven by 2 factors. One is foreign exchange, but the other is just the impact of a lower interest rate environment over a very long term. Some of that's in our business in France. We haven't split out those 2 components separately. In terms of the new business strain, let me ask Clifford if we've got that, but I believe that's because of the product mix here in the UK.
Yeah, that's right. We've had a strong half year for equity release in particular.
And I mean, just in the product mix, so if you ever look also in other countries like Italy, for example, because we restructured those business, we were able to then control the product mix, and we've changed the product mix. So our business now isn't as sensitive to interest rates as most. We've been operating that environment for a long time. The high guaranteed products and the high guaranteed businesses, the US. We sold the US because it simply didn't work for us in Solvency II. Sri Lanka, Aviva2014. So a lot of the high guaranteed businesses have been sold out, and you've seen that come through in the results. You've also seen that as well. We've boosted our margins in VMB. And so you're seeing all those actions over these last couple of years come through in these sort of results, and you should continue to see that. Oliver? So I'll get down the back and then over the side.
Oliver Steele, Deutsche Bank. 2 questions on the pension fund. I'm not particularly fussed about the volatility through the TNAV, but what number are you putting in to the economic solvency? How volatile is the pension fund number in the economic solvency calculation? And does that have an effect on your required capital? And then, if that counts as one question, the other question I've got is, what progress have you made in reducing the tax take in the central costs and interest?
Sure, I'll take both those questions. So on the impact of the pension fund on Solvency II, I guess what I'd say simply there is there still is uncertainty around Solvency II in terms of the precise application of a number of different policies and issues. So I really can't give you any good guidance on that at this point. Obviously, when we get to the end of the year, once we've gotten model approval, et cetera, we'll be reporting on a Solvency II basis and can take you through all that detail, once we get there. In terms of tax, we really haven't changed our tax policy at all. We continue to do things to try to manage our capital efficiency around the group, but there's really no update on tax matters.
Hi, thank you. Ashik Masudi from JP Morgan. A couple of questions. First on bulk annuities. You mentioned that there's some uptick on the value of new business from bulk annuities, and at the same point, one of your peers is kind of putting a word of caution on bulk annuities because ahead of Solvency II. So, I mean, what's your take on bulk annuities ahead of Solvency II from capital perspective? Secondly, there is quite a lot of improvement in your combined ratio, especially in the UK. Can you give us some color about how to think about in future? You earlier talked about when your underwriting is going up, you can switch the tap on for new business, higher volume. So some thoughts on that and sustainability on combined ratio. Thank you.
Okay, so the bulk annuities, I'm not going to talk about our competitors, but at all. I do, however, I will point out that last time we were together, we had this question. I can't remember which one asked it, and I seemed to be alone in the market thinking that the bulk annuities margins would decline. And I also seemed to be alone in the market thinking that it didn't work in some of the large areas. Now, it appears that others are probably getting closer to our view, doesn't it? So we are sticking to the mid-range bulk annuities. This is where we've been operating in because that's where we see the margins. And frankly, one of the reasons for that is that's because that's how our investment process is set up. We're set up, we're just more efficient in that segment of the market. So what you saw in annuities, to be clear, you saw overall, I think I might say, and correct me if I'm wrong, 16% drop in total annuities in terms of VNB. Within that, though, you saw about 100 million in terms of VNB come off on individual, and then that got made up by some of the other products that make up that category. So that's the way to think about it. Now, the 100 million, I'll congratulate Tom on his guidance, was exactly our guidance, and that's basically where we ended up. So there's a bit of luck in that to hit right on the guidance, I guess. The second point was on the core, and Morris and the team have done an extraordinary amount of work getting out of the products that we didn't think were profitable, and there were certain segments of the market here that we didn't like there was, vans, for example, and in terms of commercial, that the calls were just poor. And so we made some tough calls, and in the first part of the year and the year before, it did hurt a bit of our volume, and we just focused on the segments that we thought were good. Now, an interesting thing about Aviva, I got left a few legacies, but one of the positive legacies I got left by my ancestors here is the brand. And we can track this, and we know that for the same price point, we're going to pick up more than our market share. And this is pretty much the same in annuities or car or home or whatever. So all other things being equal, so for a similar pricing point, we'll pick up more than our market share. And that's the only thing we can put that down to. Our claims experience is good, but fundamentally I think, and I don't know for sure, I think that's our brand. And so you've seen us do a bit of that. We've put in predictive analytics. Obviously, we weren't hitting the floods last year as much as anyone else because of our predictive analytics. But guidance for next year, I can't give you any. One thing that Morris hasn't worked out yet is how to control the weather. And we will get factors throughout the year. I'm sure we'll get some surprises, but it's been going in the right direction, hasn't it? So I'm not able to give you any guidance, but I can just give you the factors that impact it. If we get big weather events, we'll tell you about it. But yeah, that result, particularly from the UK business, was very satisfactory. Very. Yeah. And then I'll come this side next.
Morning. It's Abid Hussain from SocGen. Just two questions, please. Can you give us an idea of the size of the potential capital synergies on your own back book on a standalone basis going forward? And secondly, how much capital would you like to allocate to the growth territories, and how much do you think is actually possible over the medium term?
The first answer is no, but I'll see what Tom wants to add to it.
No. So, we've got an active backbook program going on. Friends has an active backbook program going on. We're going to bring that together and you really look at what we can do together. But there's really not more information that I can provide on that.
You can cover the 4 areas of capital synergies, maybe.
Well, in terms of the transaction, there's sort of 4 major areas where we expect to get benefits. Some of that would be from diversification. I've talked about that before, both within the life business and then across the group. There are, some of the expense actions can be accelerated and released from reserves. There's optimization on a Solvency II basis. We've been doing a lot of work there that we can apply to the Friends Life product range and balance sheet. And finally, there's just the way we sort of manage capital in our subsidiaries when we bring their businesses over and merge them into ours through Part 7 transactions. We'll effectively create some benefits by managing them under our capital policies.
And on where we're going to allocate the capital and how much, the answer, and I'm not being evasive, but the answer depends. I see capital as a competitive sport. And when you have a look at the capital sport, as I call it, it's a group job to allocate capital to the cells and the countries and then them to use it in the most effective way. And so how much we allocate depends on the business cases and how certain they are. And we're still doing a lot of work with Jason and the team on the capital allocation model. We're not finished that yet by a long shot, frankly. But you look at a number of factors, don't you? So you look at the returns, obviously. You look at the strategic fit. And thirdly, you look at the track record of the business. And we've had some good cases recently. We've said just no because that cell hasn't been delivering. So we're not going to give capital to someone who's not delivering. Much like investors, I guess, in that regard. So if we can't find the right mechanisms and the right places to put it that have got returns in the right period, well, we'll give it back to shareholders if we've got excess. So, I mean, that's sort of the way we think about it.
Can I just come back on the first question to Tom? How many Part 7 transfers do you have in mind?
Wow. It's really two, and we've sort of got internally our annuity business and our own subsidiary that the parent there we want to merge together sort of independently, and then we want to bring in the friend subsidiary. So it's effectively two in sort of broad brush. The actual transaction details are very, very complicated.
Yeah, so I wouldn't want to give you the impression that this is a short piece of work because it's extraordinarily complicated. It's doable. It's quite complicated. Right over the side. Blair.
Thanks very much. It's Blair Stewart from BofA Merrill. Three questions, if I can. A couple for Tom. Tom, on slide 10, you helpfully isolated some of the one-offs, but I just wonder if you can clarify a little bit further, because you mentioned there's back book actions, of course, but there's also the mortality aspect in the UK. So just a little bit of clarity there, because I don't see the mortality explicitly mentioned, and also the impact that has on cash, presumably a straight read through into cash as well from those. Secondly, just coming back to the combined ratio and looking again at the helpful disclosure on slide 18. I think there's just an underlying loss ratio deterioration. I just wonder if you expect that to stabilise, whether you think 1.6 points is the appropriate level of reserve release going forwards, and whether the expense ratio can fall further. It's probably more than enough. Thank you.
Okay. A lot in that. So, one-offs, we tried to highlight on one of my first slides sort of the net impact year over year of back book actions. So that's in part due to expense actions and in part due to the longevity reserve releases. And so, just to come back on that, it's primarily favorable mortality experience in the annuity business that is driving that release of longevity reserves. And in terms of cash, what I would say is that, we're managing the UK life balance sheet sort of holistically and looking at improving the resiliency of that business and, reducing exposures there. So, yes, in theory, it translates into cash, but as a practical matter, we're sort of managing the balance sheet there, more holistically. And moving on to the loss ratio question generally, we've got a mix of businesses here, so I think you have to look at each of the businesses and the trends there. The deterioration in the underlying is primarily large losses and weather that was sort of worse than the prior year. But again, we can't really predict, as Mark was saying, exactly what the results are going to be next year. But we're trying to improve that all the time. And I'll turn over to Morris here in just a second. But in terms of favorable development, we would expect a certain amount of favorable development year in, year out. It's hard to predict that on any particular year. The prior year, we had some exceptional strengthening around commercial motor. Maybe we went too far on that because we had quite good results there this year. And in terms of expenses, I think we can do better on the expense ratio. So, Morris?
Yeah, let me just add a couple of comments. I think if you look at the reserve movement, let's talk about the two large GI businesses. So Canada was 5.5% in 13 and favorable, and down slightly to 3.5%. That's largely driven by Ontario Auto. And if you look at the UK, we strengthened in 13.7, and this year it was favorable by the 1.5. In the UK, if you look over the last 5 years, you have to remember we're largely in a short tail business. If you look at the last 5 years in the UK, we've been between +2 and -2. So we're not like some of our competitors that are in the the -10s and -13s. And your last question on expenses, I think the best way for me to answer it: am I satisfied? All the businesses have made improvement, but I'm still not satisfied. I think we have ways to go on our expense ratio.
I think the expense ratio, we've done more in the life business than we have in the GI business, frankly. And you can do expense ratio by two things. You can grow some volume, which helps, and we model the optimum volume for the expenses as well. And I think I said at the half year last year, we'd probably push some of that a bit far. And there's a balance between volume and expenses, and so that's going to be a ever-changing test for us. Yeah, Barry, and then you're next.
Morning, it's Barry Corns from Pamela Gordon. A couple of questions, if I may. First of all, going back to GI, you've talked about core. You also mentioned in the presentation about going for growth. Yeah. Many years ago, the company did a dash for growth, which was a bit of a disaster. So what sort of controls will you have on that growth, and which areas are going to grow in? The second question, again, one of your peers started to move into equity release and made an announcement yesterday. Can you give us a shape of what you think will happen to margins and the market itself in equity release in the UK, please?
Sounds like bulk purchase annuities, doesn't it? GI growth, I need to be really clear what I'm talking about as growth. I don't care less about the top line. I don't remunerate anyone in this business for top line because I think it's totally irrelevant. So growth to me is value of new business, which comes out in cash flow later in terms of life. And for these guys, it's about growth and underwriting profit is the true measure. So Morris and his team don't get paid 1 pence of bonus for growth and top line, just to be absolutely clear, because it's not relevant. So so this is an old hobby horse of mine, that the oldest game in the GI book is you grow by top line, the market seems to think it's good. Really? Well, I don't. Now, equity release. Equity release is a growing segment of the UK. It's something certainly that with the pensions gap in the UK in particular, you see the government, and I think whatever government's in power, I think you would see the government quite supportive of equity release because it helps fill that pension gap. Now, we've been doing it for how many years? David, help me out. 16, 17 years. We have quite a few tens of thousands of homes in it, where our maximum loan to value that we take is 25% or 26%? Around that, 26, okay, 26%. So it's pretty conservative. We've been doing it. We haven't found that to be, it's not a market that's driven by the competitive dynamics per se. It's driven by the distribution dynamics and the brand name and that sort of stuff. So we welcome more competitors in that. We think it's good for the UK. We think it is going to be a substantially growing market. What's the old phrase, a rising tide? I think that's going to be a rising tide, that you're going to get much more equity release over that time. Now, for us, more the question is how much capital do we want to put in it? How much concentration we want to put in, and we're nowhere near the limits of that sort of thing yet, but it's more those sort of questions that we look constantly at about that, like any other cell, where we're going to put our capital. So that's the first question I'd ask, and the second question is the execution capability of that team. But we have actually the person who heads it up in the far corner, so I'm sure it'd be like, we won't cover it now, but Clive, you can have a chat with people after the meeting if you wish.
Fahad Chingazi from Nomura. Just very two quick questions. On your 90-day core integration program, will you be in a position to, after that, affirm or otherwise the cost synergy target for Friends Life? And the second question is, on UK Motor, could you just tell us briefly what happened in Q1, where you think the market is going in UK Motor, and given your comments on growth and expense ratio, will you be following the market or doing something else?
I don't think I'll. If I can start, I'll hand over to to Morris in a sec. Our role isn't to follow a market. Our role isn't to follow competitors. I think as a company, what we try and do is we look internally and say, this is where we want to play. But what we do find is when we have a certain price point, if we match the market's price point, we'll pick up more than our natural market share. The question is, do we want to match that price point? And there's segments in the market that clearly, as we've shown, we don't, and we make the calls to get out. Do you want to add something to that, and then we'll come back to your friends?
Sure. Thanks, Mark. I mean, if you look at last year, rates were down about 6%, and that followed a decrease of about 8% the previous year. Certainly, and there's three firms that quote it. So I could look at Towers, or if you look at AA, the market did flatten out in Q4, arguably up 1 to 2. We've seen the exact same sort of valuations in that range. I'm not going to speculate on what the market's going to do. For every single risk that we write, we have a technical price, and we look at the attributes. But we also look at, to Mark's point, we look at cross-holdings, we look at the broader Aviva brand, we look at the service proposition. I think if you think out a little bit and we start to look at true customer composite, we'll price, certainly understanding the market, we'll also price based on the individual attributes that come to Aviva.
So if we just taking that forward, and this will be a lot of years to get where we want, but our strategic advantage is around quite a few countries that we're a composite, and obviously we're the only major composite here, so we have a strategic advantage. In a digital world, if people have a pension scheme and motor and house, and you can have one statement and one premium, and it's all online, and therefore you only have one set of underwriting, you've got one set of admin, it's all automated, and we're going fast. We now have the technology to do this stuff. You can see that you can take a more holistic view of the customer if you can get more of a total package from them. It's good for them because it's simpler, they get discounts, and it's good for us because it's much more efficient to administer. On your other question on the Friends Life, I'm not going to give any more guidance than the 225. There is nothing, what can I say, there is nothing we have seen that wouldn't suggest we will meet that target. But I'm not going to go any further than saying anything on that, which I'm sure you'll appreciate. Yeah.
Thanks. Gordon Aiken from RBC. Just 3 questions, please. First, we've heard in an earlier presentation the FCA's review on back books in the UK. And just can you tell us what your share of greater than 1% charge schemes are relative to your market share? That's the first question. Second question is back to the question on bulks and margins. I hear your view at the moment on large versus sort of medium-sized. I mean, much of your margins can depend on your ability to swap the gilts that the pension schemes are holding with high-yielding assets, and you already were investing in the asset management business that you have. Obviously, this deal adds a huge amount of scale. I was just wondering, I hear your view now, but your ability to get those high-yielding assets is obviously picking up. So is the view going to change on large-size bulks maybe a year down the line? And the third question just on the pension scheme. You did a longevity swap last year. You set up a captive. Just wondering, the favourable longevity you're reporting today, did you manage to lock that in the deal that you cut with the reinsurers?
Okay, so Tom will take the second, third, and I'll take the first, and I'll get part of the answer from in front of me too. Just on the FCA review, just to be clear, we're not in it. Okay, just because the percentage of our book versus the market that would be covered by that review is small, and they're very aware of what we've done. So we're not in that review. And that probably helps. On the other two?
On the bulks, in terms of the assets, we're investing there in a range of assets. We're continuing to look at potentially new asset classes over time, but we've been getting good returns in equity release and commercial mortgages. So that effectively drives part of our appetite going forward. But so far we've had pretty good performance there. And on the longevity swap question, John Lister, I mean, I guess I'd say that we've locked in the results in that transaction. I'm really not sure where the question's going though.
I think your question is, did we get the right terms on that transaction? In which case the answer is yes. So we were looking forward on the actuarial tables. Clearly pensions is different to immediate annuities. We had a very competitive process, and we got a good rate, and we're happy with it.
I mean, our philosophy on all these things is you've got a market at the moment that craves yield, that craves return, And so the way we look at our business is we keep on standing back and saying, look at areas of risk in the business like that one, and if the returns, if the prices you can get at the moment make absolute compelling sense, well, we say we do those, and that's one example of that for us. Okay. No one. Any further questions? Well, I think on that note, ladies and gentlemen, thank you as always for your participation, and I, as always, look forward to reading what you write.